Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A second bearish black crow yesterday and a suitable follow-on lower to the previous session's bearish harami. The market is continuing to see pressure from below and now also from above. It was another day of the market piercing but not closing over the declining short-medium moving average, currently at 107.28. The cap on the day was once again the May 2020 low at 107.66, along with the rapidly descending February to date downtrend, currently 107.56, pressing down, if not actually touching the market from above. The market made a second consecutive close below the April 2020 low at 107.25. Looking below, we now have the considerable and interesting support from the declining middle time, currently 106.63, of the well highlighted January to May 21 bearish Andrews pitchfork. Now, stepping back a bit, this pressure by the short medium moving average for just over a week now is important. I would only ask you to look upwards on this daily chart at the last time the market met the short medium moving average back at the end of March and the resultant move lower thereafter. It'll be interesting to see what the market makes of it this time, whether it makes its own way or repeats what happened back in late March. Looking further below, the next support is the 2020 low at 106.35, but the better support starts from the April 2017 low at 105.68 and extends lower thereafter. Meanwhile above, beyond the February to date downtrend, we have the declining medium moving average, currently 109.42. So far today, well, a small but significant move lower, down to rest upon the middle time, and then pull back to almost unchanged and looking like a indecisive spinning top right now. Cable, aka sterling against the US dollar. A counter to the counter bullish harami yesterday, as the market continues its very recent intraday indecision. It seems the market is still fed up of the failure earlier last week to break the highlighted overhead resistances at 126.72 and the September 2020 low at 126.86, which had recently capped this market. However, it's also a bit fed up at the support below between 124.78 to 125.09, which contains the 38.2% Fibonacci line of the March 20 to June 21 move at 124.89. So far today, well, a surprising move down through the quagmire of support between 124.78 and 125.09, reaching down as far as the next support below, 124.36, before pulling back into the quagmire. We have limited support until the June low now at 122.48. However, last month a small congestion area was grown between 123.17 to 123.37. Euro sterling. Yesterday we may have had what could turn out to be a significant immediate countering key reversal down and bearish engulfing pattern. We shall see over the next few days if this does develop into something. One of the other reasons this may be important was the piercing and close yesterday below the lower time, currently 85.71, of the mid-April to mid-May bullish Andrews pitchfork. The first time we've had a close below. The market also pierced but did not close below the functional support of the mid-May today uptrend, currently at 85.37. Further down, we still have the supports of the April 21 low at 84.70, also the broken September 2021 to date downtrend, currently at 84.60. That makes up the upper trend line of the extended diamond pattern, then the flatlining long moving average, currently 84.40, the rising short medium moving average, currently 84.34, and the upper trend line, currently 83.97, of the smaller and more robust lopsided diamond pattern. For the moment at least, we still have the upside, on the upside, for the smaller lopsided diamond pattern, a primary target X in the 86.80 area and a harder to get secondary target X1 in the 87.65 area. And for the extended diamond pattern, we also have a primary target X2 in the 87.15 area and a harder to get secondary target X3 in the 88 even area. Additionally, there's also the one final pattern, that is a big one, which this market previously triggered but then also sent some mixed messages on. I've spoken for weeks, months even, with a very large falling wedge pattern, currently 84.60 to 81.48. This pattern is still in operation, but has fallen into the shadows a little of the rising prominence of the diamond patterns. And though triggered, the pattern still leaves us with some questions. You see, it has the most ambitious upside target of all, Target X5 for this pattern is in the 88.65 area, and that is a real big ask. So far today, we're a reactionary surge back up through the lower time, but peaking soon thereafter, just under yesterday's high, and then dropping back down to the pierced uptrend before holding steady right now, looking like an indecisive spinning top with a really big tongue on top. US dollar against the Indian rupee. A second bullish white soldier yesterday and a follow-on higher from the, well, let's just call it the almost day from last Friday, where it was a little too much to be a bullish double and a little too little to be a key reversal up. It was nevertheless a continuing reactionary move back up from the merest touch of the lower time, currently 77.46, the January to April bullish Andrews pitchfork. This time pushing up and closing over the broken lower trend line, currently 77.69, of the May to day ascending triangle, well, a May to day based ascending triangle. So it seems late last week's move lower might have been a false break. Overall, the market is still within the new congestion zone between 77.40 to 77.80. However, as I've recently stated, there seems to be a possible new element in the mix. You see, overall, the market is still in between the previously mentioned lower time below and the middle time now above, currently at 78.91, the mid-January to early April bullish Andrews pitchfork. Plus, we still have overhead target X in the 78.30 area. This is the potential target of the whole of the 2022 action, that is, being a possible bullish halfway hesitation. So far today, well, a lower open and a tentative attempt to test the broken lower trend line with limited effects. Right now, we're looking like a possible small bearish harami. US dollar against the Brazilian real. A reactionary bullish double yesterday with a tail that dipped down below the support of the 50% Fibonacci line of the October 18 to May 20 move at 477.54, but a move that was not sustainable as prices closed back above it. Overall, the market is still stuck within a congestion band, the support of which I have just detailed, and overhead resistance comes from the short medium moving average currently at 483.55 plus the 50% Fibonacci line of the June 19 May 20 move at 484.26, along with the June 20 low at 481.62. Now further below we have the heavily marked congestion at 472.90 to 472.92. Although prices have recently dipped below there, as well as the next support 471.42, the market has still failed to consolidate any move lower, despite some overtly bearish actions, at least not yet. Thus it may well be that last week and perhaps the start of this week is a rest period for the market. In a bit bigger picture, we are still in between the upper time, currently 501.23, and the middle time, currently 455.14 of the January to May bearish Andrews pitchfork. This is still an early development bearish pitchfork, but it is starting to show some merit in forming and hence showing the recent bearish angle of attack. It'll be interesting to see what happens if and when the market approaches any times below or above. US dollar against the Mexican peso. An interesting and I suppose surreal pattern yesterday. It was an indecisive doji cross, but it was also a key reversal up, if only just. All this was based on support of the 2021 low at 1953.65. Overall, we are still riding down the top side of the middle time, currently at 1941.98, and November 21 to March 22 bearish Andrews pitchfork. Overhead, the next resistance is at 1971.68, the April 22 low. Whilst under the middle time, if only just, we have last week's low at 1940.70. So far today, well, a slightly higher open and a small move lower, dropping below the 2021 low, and making today, even with its limited range we've had so far, even with this limited range, looking like a bearish engulfing pattern right now. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Invest Services International Limited. And here comes the final bit.